All right, welcome to Talk Tickers. Today, we're diving deep into the Kohls Q3 earnings call, and let me tell you, it's a really interesting story. We're seeing some green shoots, some real signs of a turnaround, but at the same time, their main customer base, they're still feeling the pressure. So let's get into it and figure out what this all means for the path ahead. So let's start with the headline number. Kohls delivered an adjusted earnings per share of 10 cents. Now that might not sound like a lot, but here's the kicker. It crushed analyst expectations. And this isn't a one-off. Nope. This is the third consecutive quarter they've pulled off a beat. That's a trend worth paying attention to. Okay, so here's how we're going to break it all down. First, we'll hit the Q3 results. Then we'll get into the nuts and bolts of their turnaround plan. After that, we'll talk guidance and the analyst Q&A. And finally, we'll give you our take, the next call. All right, section 1, the Q3 results. That earnings beat was great, but the real story, as it so often is in the details. There's more going on here than meets the eye. Now check this out. This is where things get really interesting. Look at the comparable sales growth. In Q2, they were down 4%. Ouch. But in Q3, that improved to negative 1.7%. That's a huge sequential improvement. And get this, management said that in October, comps actually flipped positive to plus 1%. That is a massive data point. So let's look at the whole picture for Q3. Net sales were down a bit, but hey, look at digital, up almost 2.5%. That's a great sign. But what I'm really impressed by is the operational side. Inventory is down 5%. That means they're not getting stuck with stuff they can't sell. Gross margins are up, and they're cutting expenses. That is just solid blocking and tackling, and it's helping the bottom line in a big way. And here's maybe the most crucial point of all. The Kohl's card customers, we're talking their most loyal core shoppers. Their spending trend improved by over 500 basis points from Q2. That is not a typo, 500 basis points. It tells you their most important customers are starting to re-engage, and that's a direct result of the big strategic shifts we're about to cover. Okay, so that's the what. Now for the why. Let's get inside this turnaround plan and see how management is working to re-engage their core customer. Management has really centered its entire effort on these three key things. It's not rocket science. It's about getting back to basics. 1, have a curated assortment of products people actually want. 2, reestablish that sense of value. And 3, make the whole shopping experience frictionless. It's all about correcting past mistakes and getting back to focusing on the customer. And the CEO, Michael Bender, he hammered this point home on the call. He said, we focused a lot of attention on making sure that what we're offering to customers, particularly from a value perspective, is what they're looking for. It's all about the product and restoring what they call trip assurance. That feeling when you go into a store knowing you're going to find what you need. That's what they're trying to bring back. And this chart, it perfectly illustrates where the strategy is hitting and where it's missing. Look at accessories, clearly outperforming. That's a big win. Then you've got the core stuff, women's, men's, home. They're improving, moving in the right direction. But you can also see where the work is still needed. Footwear and kids, yeah, those are still a drag on performance. So let's talk about some tangible wins. Their own private label brands, they're back to positive growth. That's huge. We're talking Conrad, Simply Vera. These are leading the charge. And even simple things like moving the juniors and accessories sections around in the store are actually driving sales. And here's a big one. They brought back coupon eligibility for about 50 brands. Customers love that, and it's clearly working. All right, next up, guidance and the Q&A. This is where we get a sense of how they see the future and how they're thinking about navigating what is, let's be honest, a really pressured consumer environment. So despite that Q3 beat, management is being pretty cautious with their full-year guidance. Look at these numbers. They're basically signaling, hey, things are getting better, but we're not out of the woods yet. And why? Because they know their low to middle income customer is still getting squeezed, and that's going to be a headwind. And this right here was the billion-dollar question from analysts. It's what every single investor wants to know. How are you thinking about the path to sustainable top-line growth, right? Is this improvement real and lasting, or is it just a temporary bounce? When do we see consistent growth again? So how did management answer? Well, they were pretty disciplined. They basically said, look, we know there's more work to do. They're using that positive 1% comp in October as a proof of concept, a sign that the plan is working. But their core focus remains on getting the product right, the assortment, the style, the relevance. And importantly, they gave absolutely no specific timeline for a return to growth. This is a multi-quarter turnaround, not a quick fix. Okay, so let's put it all together. The results, the strategy, the outlook. It's time for the next call. Here's our take on KSS. We are initiating our coverage with a market perform rating. And what does that mean? It means we expect the stock to perform pretty much in line with the rest of the retail sector over the next 6 to 12 months. It's really a reflection of a balanced view. We see those green shoots of recovery, but we can't ignore the pretty significant macroeconomic headwinds. Really, the whole debate for Kohls boils down to one simple question. Can their internal improvements offset the external pressures? The bull case is pretty clear. Their core customer is coming back, their own brands are gaining steam, inventory is clean, and they're generating solid cash. But the bear case is just as compelling. Their customer is under pressure, key categories like footwear are still weak, the holiday season looks super promotional, and oh yeah, the Sephora business actually had a negative comp. That's a big red flag for some. So, what's a potential trade idea here? Well, if you're someone who believes management has basically put a floor under the business, but you're not convinced about huge upside in the near term, you might look at selling some short-dated out-of-the-money puts. It's really a play to collect some premium on what you perceive as newfound stability. So, to wrap it all up, our final take is this. The turnaround is absolutely showing promise, but the risks are pretty balanced. You could say management has finally pointed the ship in the right direction, but they happen to be sailing directly into a hurricane of consumer weakness. And that's what leads us to our market perform rating. And of course, this is not financial advice.